Hello, everyone. Welcome to episode 4 of Money Monday, because it is Monday and that's when we talk about money. And because I couldn't come up with a catchier name for the show. So you're welcome. I am Kyle Thompson. I am the founder and managing principal of Lead Town Advisors, which is a wealth management and business advisory firm. We're going to give people some people are coming in right now. We're going to give people time to come in. That was one of the criticisms I've received is I just start right away. So we're going to give this a couple minutes before we get started. But we have 5 questions we're going to answer today as usual. And this is all about end of year planning, end of year financial planning, which is based around both general financial planning, taxes, and business planning. So I'm gonna try to cover a lot today. I'm gonna try to keep it under a half an hour. But I might have to rush some of this, and I may turn some of this into a 30-minute piece of its own. So the five questions we're going to answer today is: 1, what should I do to maximize my retirement savings? 2, what should I do with my employee benefits / insurance? 3, what issues should I consider as a business owner? 4, what are my options for charitable planning? And 5, should I do a Roth conversion? And Roth conversions are important, so stay tuned to that. And if you're watching this after the fact, you should at least watch that part because it's important. So yeah, I guess let's get started. So question 1, what should I do to maximize my retirement savings? So the first question is, are you on track for your savings? So, I mean, the question, should I maximize it? Doesn't, if you're already on track, it doesn't matter. Because money is meant to either be spent or given away. So the money you save is money that eventually needs to either be spent or given away, either through charitable giving or an estate plan or both. But if you don't know whether you're on track, that's some good rules of thumb to know are: if you want to retire by 70 and maintain your lifestyle that you have now, you should be saving at least 5% of your income. If you want to retire at 65, that needs to be 10%. And if you want to retire at 60, that needs to be 20%. And that is on your gross income, not your net. So that's the money you make before taxes are taken out. So if you are making $120,000 a year as a household, that's $24,000 a year that you need to be saving, which is $2,000 a month. So however you get to that, that's what matters. And I do like to see savings split between retirement contributions and taxable brokerage contributions. I like to see that at a 50-50. So you'd be saving 10% into a traditional retirement bucket, whether that's 401k, Roth IRA. It depends on your personal circumstances. So this is just general outline. And the other 10% would go into a brokerage, which has a lot more flexibility and optionality to it, which is why I like it. And there's no limits to the contributions you can make. Whereas retirement plans do have limits on their contributions, such as a 401k for 2021 has a $19,500 limitation on contributions, on employee contributions. It also has that same limit on employer contributions and profit sharing. If you're not sure what those are, let me know and I'll do more about that in a future episode. So if you're fairly high income, there's a good chance you are maxing out your 401k anyways, or other retirement plan that you happen to have. There are different limits on different kinds of plans, such as a SEP IRA has much different mechanics than a simple IRA, which are both employer sponsored plans, and you need to know that difference. But if you have it, yeah, but by far the most common are 401ks. But you need to know those limitations, which are 19,500. So if you were making 200,000 as an individual and contributing 10%, you are definitely maxing that out. Speaking of employer-sponsored plans, you need to check to see what your match is. You need to see if your match is 2%, 3%, 4%, 5%, 8%. Some places do have a really generous match of 5 or 6%, and that can be factored into your savings as well. That factors into that 20%. If you're self-employed, this is a really important distinction for self-employed people, and I know I have at least one person on here that is self-employed. Let me look at the participants again. Yep, one at least self-employed person. So a solo 401k is incredibly important for you, because between the individual contribution, the employee contribution, the employer contribution, and the profit sharing contribution, you can put up to $58,000 away, either pre-tax or post-tax, depending on how your solo 401k is set up and what the summary plan document says. So you can defer a lot of taxes, or you can pull forward a lot of taxes, depending on what is more appropriate for you. And then lastly, brokerage account. So that's just a standard taxable account, which is like a savings account that you can hold investments in. It is very tax advantaged. You can hold pretty much anything you want in there. You can contribute as much as you want. You can take money out without any penalty. Any taxes are at the capital gains rate, so which are very, very advantageous for most people. And you can also use it as a line of credit. I personally use mine as a cash management account, and it works incredibly well. So yeah, maximizing retirement savings, that's a big piece. Now, what should I do? So question number 2, what should I do with my employee benefits and insurance? So first off, you should check to see what your coverage is. So there's basically 4 different kinds of insurance that employers generally provide. That's, or I guess 3 kinds, healthcare, disability, and life insurance. So let's start with healthcare. The 3 big types of coverages are PPO, HMO, and HDHP, high deductible plan. PPO and HMO typically have lower deductibles, and you might want to switch to that if you know you're going to have significant health events next year. Like if you know you're going to have surgeries or lots of screenings of something, then you probably want to have a PPO or HMO. Those come with an FSA, a flexible spending account, which is great. A lot of times the employer makes a contribution to that, and you can make an additional contribution. But the downside to an FSA is that it's use it or lose it. You have to use that by the end of the year, or it gets redistributed to you, which isn't the end of the world. So it's not like you literally lose it. It just goes out of that account and gets paid back to you. An HSA, on the other hand, is something you have access to as part of a high deductible plan. The limits on that are, like roughly $3,500 per person, or $7,000 for a family. It's somewhere in that range. Don't quote me on that. I can't remember all these numbers and shit. But it's somewhere around that range. So that's another way for you, especially if you are high income and you are healthy, it is a way for you to defer taxes. And especially if you are getting close to retirement, there's a lot of different other tax advantages to that kind of account that are not available to like an IRA. For example, with an HSA, even if you don't have any health events, which any money that you use from your HSA for a health event, qualified health event, is tax-free. So good there. But also you can use it to pay for your Medicare premiums. So especially if you are over the age of 55, between 55 and 65, an HSA is incredibly useful for planning purposes. So keep that in mind. So the second type of insurance that employers tend to offer is disability. So there's short-term disability and long-term disability. This is usually expressed as a percentage of your salary, and I have a lot of clients that are salespeople that work on commission with a low salary. So the long-term disability insurance covers only 2/3 of their base salary, which may be 50,000, but they may make another 200,000 or 300,000 of commissions on top of that. And 2/3 of 50,000 is not very much. It's not anywhere close to 200,000. So a lot of times they will have to go outside and go into the marketplace and purchase additional disability insurance. There's a lot of planning that goes in and risk management that goes into what kind of disability you should or should not have. And I don't want to give blanket statements and advice on disability here. But it's something to be well aware of, because it is one of the most overlooked planning areas. The third kind of insurance that employers typically provide is life insurance. Life insurance generally is very cheap through a group offering. The downside is, though, that once you leave your employer, that does not come with you. It's not portable generally. Sometimes it is, but at a huge premium. So especially if you are young, if you're in your 20s or 30s right now, it's really important to get a policy outside of your employer plan, so that you lock in that low rate while you're young and don't have to worry about it when you're later, when you're older. How much life insurance should you have? Well, that's, again, like disability, there's a lot of factors that go into that. If you're young, 10 times income is definitely a good starting point. As you get closer to retirement, and especially if you're well funded for retirement, you don't need nearly that much. So there's a lot of nuance that goes into disability and life insurance planning that I don't want to get into today because I'm already 10 minutes in. All right, now question number 3. What issues should I consider as a business owner? Well, first off, you should do a review of your goals for the year. Did you have any goals? I would hope so. Every year, at the end of every year, I sit down with my business owner clients and create some sort of goals. These can be very in-depth, they can be very high level, but some sort of goals for what you want to do the following year. Those can be top line goals, like I want to grow my revenue by 40%, or it can be bottom line goals where I want to grow my personal income by 25%, or I want to grow my headcount, my employees by I want to hire 2 new people. It can be a lot of different things. It can be a combination of things. But the first thing you should do is a goals review. Where you're at in relation to them, what happened to either set you above or below that, and what you're going to do for next year. So first thing is goals review. Second thing is a business valuation. Now, because I get a lot of questions from business owners of what is my business worth? Now, the answer to that, the first question you have to answer is, do I have a lifestyle business or an enterprise business? The difference between those two is a lifestyle business, you treat the business as a source of income, whereas an enterprise business, you treat it as an asset on your balance sheet. Now, again, that sounds overly technical, but basically, ask yourself the question, is this business valuable to anyone else? Is it transferable? Is there any transfer of value that I can do? In other words, can someone else do my job? If the answer is no, then your business isn't worth anything. And I know you have to set aside your ego to be able to answer that question, but that's the truth. The chances are someone else probably can do your job. And that's the idea of someone buying a business, is they're buying some sort of transferable value. Now, if you answer the question, yes, someone else can do my job, then it's worth doing a business valuation. And that's what I do for every client, every enterprise client at the end of the year. From there, you can track your growth rate. So like if last year your valuation came in at 3 million and then this year it's at 4 million, well, that's a 33% increase in value. What did you do to drive that value? What happened? And so then you can put things in place to keep running with that. The third thing you should look at as a business owner is what retirement plan you're using, if any at all. So if you are solo, if you're alone, if you just run a lifestyle business with with just you and some contractors, because contractors do not need to be included in a retirement plan, an employer sponsored plan. If it's just you and some contractors, you can do a solo 401k, which is pretty cheap to set up. It costs roughly $500 to $1,000 to set up, depending on the plan provider. And from there, you can stuff away a ton of money. It's not really worth doing a solo 401k if you're making less than $100,000, because you might as well just do a Roth IRA and a brokerage account. That'll make it much cheaper. But once you get above six figures, and especially once you get above 150 in income, it definitely makes sense to put a solo 401k in place. Or if you have employees, it may make sense to do a traditional 401k or a safe harbor. Those are two different kinds of 401ks based on the kind of reporting and then the balancing that's involved. Because 401ks are meant to not discriminate against employees, whereas safe harbor 401ks allows the employer to put away much more money than a traditional one would. There's other different types of retirement plans like simple IRAs, SEP IRAs. But honestly, those are kind of second best. They're cheap to do. But 401ks have come down so much in cost as far as administration goes, startup and administration, that if you're thinking of doing a retirement plan, you might as well just jump straight to 401k. There's also different kinds of non-qualified retirement plans like 457s, phantom stock, other things that if you're getting to especially if you're in professional service, it's worth doing. Or if you're a very large company with a executive team, like over 100 employees, and you have an executive team, then some sort of non-qualified deferred compensation is definitely on the table as something that might be worthwhile. So after looking at retirement planning or the retirement plans that are in place, doing a cash flow projection for the following year is going to be important. So, and looking at what you did this year. So, take what you've done so far this year, because hopefully you have a bookkeeper, or if you don't have a bookkeeper, you're doing your own books and they're up to date. And you know where you're roughly going to be by the end of the year, both as far as top line and bottom line. Both of those are important. Don't just look at one or the other. You want to look at your top line and bottom line and be able to get your profit margin and be able to look at that year over year. Because if you're normally at a 25% profit margin and for some reason this year was only 20%, well, what happened? Did input costs go up? That may mean you have to raise your prices, things like that. And you want to do, and then being able to do a cash flow projection for next year is also, part of that goals review that I mentioned earlier. And that allows you to put things in perspective, especially, if you did say $1 million in sales this year, and what's a reasonable growth rate from there? Well, it depends on the industry. If you're in e-commerce, 40% growth rate is not unreasonable. So if you did $1 million this year, $1.4 million next year is not unreasonable at all. So doing those projections, setting goals is important. And from there, we can back into your tax estimates too. So if your projection is to do, 100 or 150,000 in net sales next year, in net income, then we can plan your tax estimates, your estimated payments based on that. And then every quarter we can adjust and see where we're at. Another thing you want to do towards the end of the year is look at, hey, what expenses do I have coming up next year? And should I pull those forward? Meaning, hey, I'm going to need a bunch of computers. Like, let's say you have a bunch of computers that, or, equipment that are going to be uh, up for, you know what I'm trying to say. You need to buy new shit. You need to buy new shit and you want to minimize your taxes this year. Like if this year was a particularly high income year, pull those expenses forward before the end of the year so you can deduct them in this year, whether or not that's through traditional depreciation, section 179, or if they're below de minimis, that's fine too. But you want to look at pulling those expenses forward, especially if you had a really good year, and want to pull those forward. All right, we're getting low on time here. If there's any questions, please put them in the chat and I will answer as best I can. So question 4, what are my options for charitable planning? Well, part of the Secure Act that went through 2 years ago is they added an above the line charitable deduction, which means that you can deduct a certain amount from your income and get that charitable deduction for it, even if you don't meet the standard deduction. So that limit for an individual is $300. That limit for a couple is $600, and that means even small amounts can be deductible. So taking 300 or 600, whether you're single or married, and making that deduction here before the end of the year, you can do that. Now, if you want to contribute more than that to charity, and you are not above, and you're not contributing enough to be above the standard deduction, which for an individual, if for this year is roughly 12,500, and for a couple is roughly 25,000. If you're not above that standard deduction, the best thing to do is do bunching, which means rather than spreading. So if you were going to contribute, $10,000 a year for the next 5 years, instead of that, think about contributing $50,000 in 1 year, because here's the standard deduction. But if you're below that, you won't get any deductibility whatsoever. But by doing it all in 1 year, having it up here, you get at least some deduction for that. And if you don't want to actually distribute that money to the intended charities in the meantime, what you can do is put the money into what's called a donor advised fund. And then that you get the deduction this year, but it can distribute the money over time. So that's the advantage of a donor advised fund. That's typically if you are contributing, that's worth it if you're contributing less than, let's say, $150,000 at a time. But if you're looking to do some serious charitable planning, then a charitable remainder trust is going to be what you want to look at. Now, there's charitable remainder annuity trust and charitable remainder unit trusts, which are an important distinction, but not worth going into right now. But if you are looking to donate some serious money over the course of your lifetime, those are things to look into, especially if you want to contribute more than, say, $250,000. Those are definitely the way to go. All right, last question here, because I only got 5 minutes left. Should I do a Roth conversion? First off, what is a Roth conversion? That is when you take your pre-tax money from an old IRA or 401k, pay the taxes on it now, and move that money into a Roth account. Now, why the hell would you want to pay taxes now? Well, if you are in the 10, 12, 22, 24% brackets, that's probably the lowest brackets you'll ever be in. And those are all going up significantly when the TCJA, the Tax Cuts and Jobs Act, sunsets in 2026. That's in a little over 4 years. So basically, if you are in the 24% bracket or less, you probably want to do a Roth conversion. Now, what is the 24% bracket? That is for individuals making less than about 170,000, or for couples making less than 340,000, which is a pretty big range. That's pretty decent cap there. What that is driven by is based not on your tax bracket necessarily, but your tax budget. If you have room in your budget, so if you have, let's say you have your personal income is $120,000 this year, you have 50,000, and then you're single, you have 50,000 in your tax bracket to be able to do conversions, but you're not going to want to do $50,000 in conversions because that's going to cost you 24% plus state in taxes. That's going to be a big hit. So, because that's going to be what, about 15,000 give or take in taxes, depending on which bracket which state you're in. So that's $15,000 in taxes, which probably isn't ideal. No one wants to pay that much extra. So I would think about this in terms of how much extra you are willing to pay. That a lot of times that ends up coming out to, most of my clients say somewhere between 1,000 and 10,000, and we plan based on that. The best time to do a Roth conversion is when either you have a low income year, so like last year 2020, if you're a business owner, or if you got laid off, or this year, if this year just sucked, then it's a really good year to do a Roth conversion, especially if you're normally in a higher tax bracket, but now you're in a lower tax bracket and you have the cash to spare. It's definitely worth doing. The second situation where it's definitely worth doing is if you've just recently retired and you have a bunch of pre-tax money. So if you're 60 years old and you have 12 years before RMD starts, we can take all of that money and convert it for very low rates in the 10-12% bracket, so that you either never have to take an RMD, or your RMDs or required minimum distributions are much lower. And a lot of times with my clients that are retiring in their early 60s, we have it planned out so that they'll never pay taxes again after the age of 70, despite having a net worth of millions of dollars. Another situation where it's worth doing is if you live in a state with no income taxes, like Tennessee or Nevada or Texas. Yeah, Texas doesn't have. And then also, in a weird edge case scenario, is Illinois. Illinois does not tax retirement accounts. So if you have a balance in your retirement account, you can do a Roth conversion and not pay any state taxes. So that's something to be aware of. And I also have a feeling that is going to go away eventually. So if you are someone in Illinois, that's something to be aware of. All right, that's pretty much time for me. That's all I got today. If you have any other questions, please send them on to kylet@leetownadvisors.com. And I will answer any questions you have. And if you have any ideas for topics, I'm happy to do that. Some things I have coming up are a little more. I am planning on doing a webinar on lifestyle business versus enterprise business and how to plan around that. I'm planning on doing things around employee equity compensation, like restricted stock units and stock options, etc. I'm looking to do things around mindset, taxes, a whole bunch of stuff. So if there's something in particular you want to see, please let me know and I will get that done. All right, that's it for the 4th episode of Money Monday, and I will see you guys next week. Thanks a lot. Bye-bye.